Has the age of the Silicon Valley tech unicorn finally come to an end? Is that the day that everyone has secretly been waiting for? Are unprofitable tech companies about to crash and burn? Is that a good thing or a bad thing? Well, I suppose that depends on your perspective. We are covering this subject closely because this is the subject of the most widely viewed videos on this channel. This video continues our coverage of the wave of layoffs sweeping the United States. What does it mean for big tech companies? What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. It was fun while it lasted. After more than a decade of stratospheric valuations, the unicorns are facing a scary future. Silicon Valley is in the middle of its worst sell-off since the 2008 Great Recession. The pandemic economy was like a dollop of high-fructose corn sweetener dropped on tech companies. The boom created by the pandemic sent tech stocks soaring. But now quite a few of those tech stocks have experienced their worst 6 months as public companies. For example, Peloton, the connected exercise bike startup, is a case in point. Peloton shares are now trading at $17, which is down from their all-time high of $163. The board of Peloton is reportedly looking to sell a minority stake in the company to a new outside investor. Investor sentiment in Silicon Valley is the most negative since the dot-com crash, said venture capitalist David Sachs. Unprofitable tech companies may not survive an economic downturn. Many of these companies are still in their early stages and need more time to develop profitability. At this stage of growth, they rely on constant infusions of venture capital. These capital infusions cover expenses while management focuses on growing the company. But this is difficult or nearly impossible during times when consumer demand slows down. Unprofitable tech companies known for raising millions of dollars to achieve enterprise valuations in the multi-billion-dollar range are now laying off employees. One prime example is celebrity video clip company Cameo. And, of course, Robinhood. And Thrasio, company that trades in third-party brands on Amazon. Workrise, an employment group, is another example. These unprofitable tech companies have come to be known as zombie unicorns. In other words, they are billion-dollar startups that cannot survive on their own. And now they need new investors to come and rescue them from potential bankruptcy. A lot of this is about companies that never thought the VC gravy train would slow, said finance columnist Dan Primack. This is an epic and generational event that is causing investors to reconsider tech company valuations. Many investors are waiting for massive valuation markdowns as the tech bloodbath develops. Investor sentiment has clearly shifted. And the entire macroeconomic environment is on a different footing. Our economic environment is less certain. The ground on which the tech landscape stood is beginning to look like an abyss, said venture capitalist Dan Rose. What the whole tech world has been waiting for is probably already happening. The age of the Silicon Valley unicorn is over. Tech companies of all sizes are laying people off. You guessed it, that includes layoffs at Google and Meta platforms. But, wait. Those companies never said the word, layoffs. Well, yes. But they have danced all around the word so much that everyone thinks they said it. But we all know that it is coming. Google and Meta platforms reported decidedly disappointing Q2 earnings. Meta has posted shrinking revenue for 2 quarters and maybe a third quarter as well. And both companies promise to make adjustments in the future. Both companies have hinted at layoffs but not actually made detailed announcements. Meta Platforms management promised cost cuts, hiring freezes and ruthless prioritization. Meta has begun quietly pushing out a significant number of employees. The company has restructured departments and given employees 30 days to find a new job within the company. This enables the company to cut a lot of positions without having to issue pink slips en masse. Meta has about 83,000 employees, which is 32% higher than at this time last year. Alphabet has 174,000 employees, which is 20% higher than this time last year. But the United States is now teetering on the brink of recession and the digital ad market has plunged. Realistically, there are probably a bunch of people at the company who shouldn't be here, Meta CEO Mark Zuckerberg said at a company town hall in June. Meta head of engineering told managers to fire all employees who were coasting. Shares in Meta platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. Speaking at the Vox Code conference, Google CEO Sundar Pichai said that Google needs to be 20% more productive. Google and Meta are probably the most notable of the companies reducing headcount. But there are many others. Real estate platform company Compass has just announced that it completed its second round of layoffs. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Last week, Twilio announced the layoff of 11% of its employees in a broad financial restructuring. Despite the wave of layoffs sweeping the United States, people seem to be able to find new jobs in a matter of weeks. Another survey from PricewaterhouseCoopers shows that half of all companies expect to lay off employees within the next 12 months. Snap, owner of Snapchat, announced a 20% reduction of employees. Apple announced that it is cutting 100 positions and slowing hiring and spending. Oracle, the worldwide software giant, has cut hundreds of positions but declined to say how many. Crypto trader Coinbase announced a 20% workforce reduction. Crypto lender Genesis cut 20% of its workforce due to what they call turbulence in the cryptocurrency market. Even companies that are not considered to be in the technology space are announcing job cuts. Walmart is cutting 200 corporate employees. Car giant Ford announced that it is cutting 3,000 salaried and contract workers. Wayfair, the Boston-based home goods company, Wayfair is cutting 870 employees worldwide. HBO and HBO Max cut 14% of its employees, which is about 70 people. Bed Bath & Beyond, the latest meme stock, is cutting 20% of its corporate positions as part of what management calls a major restructuring. Electronics retail giant Best Buy has cut hundreds of jobs in its stores across the U.S. due to what they call a challenging macroeconomic environment. Online prescription glasses retailer Warby Parker is cutting 63 corporate positions. Google, which has not yet formally announced layoffs, said that there would be an overall review of sales performance and performance in general. Last month, Meta Platform CEO Mark Zuckerberg told employees that the company plans to reduce its hiring target for engineers from 10,000 to between 6,000 to 7,000 amid the market downturn. Realistically, there are probably a bunch of people at the company who shouldn't be here, Zuckerberg said. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.